Welcome back everyone. So today we're going to be looking at a few companies which I have recently added to my portfolio, and they are all part of a sustainable portfolio that I'm attempting to integrate in. Now, before we jump into the stocks and ETFs, I have the personal belief that stocks that operate in a way that is good for the environment, in the future, there's a high probability that they will outperform competitors that choose not to do so. This isn't backed by any studies, but my reasoning is because as laws become tighter to get businesses to operate in a sustainable manner, companies that fail to do so will no longer have that competitive advantage. So personally, I feel that in the long run, such companies that embrace sustainability with respect to the types of products that they build or the partners that they work with, there is a higher chance that they can become industry leaders. So the first company that I want to take a look at, and I would say that they have this sustainable green approach in mind, and that is the Renewables Infrastructure Group Limited. So on the screen I have ticker symbol TRIG. We can see that I currently own £59 worth. That equates to around 44 shares. Now the price point is very low, it's currently £1.35. So that's great, I own this company. What exactly do they do? So TRIG serves to generate sustainable returns for shareholders from a diversified portfolio, and the goal here is to have a zero carbon future. Now right now the dividends have been suspended. That's something to keep in mind. Generally I like to buy companies that are actually paying out dividends, but I do see the long-term potential for this company, and looking at their financials it looks pretty healthy. And so moving on to the second company that I invested in this week, and that is company DS Smith. So ticker symbol SMDS, I currently own £235 worth. That equates to around 79 shares. Already they are up 7% since I personally invested into the company. And so SMDS is an international packaging company, and they are already included in the FTSE 100 index on the London Stock Exchange. And although it's debatable, delivering packages in cardboard boxes can reduce carbon emissions to that of plastic-based package items. So this company is very basic. They deliver boxes. Companies can buy those boxes and package their goods. With the likes of Amazon and other demands for carbon-based packaging, and with a healthy financial balance sheet, I decided to invest in this company just to add to my sustainable portfolio. Now the final investment that I made this week is not actually a company, but it's an ETF, and it's the iShares Global Clean Energy. So ticker symbol INRG. So currently you can get this for £8. It's actually at one of the highest prices right now, but because I wanted to include this in the video, I just brought £10 worth, so 1.24 units right now. I'm definitely going to be adding more in the future. Now, iShares Global Clean Energy is an interesting ETF because it actually provides exposure to the US. At the same time, it's listed on the Irish Stock Exchange, and so we're not having to pay any conversion fees there in the form of exchange rates. Now, the dividend yield appears to be around 1%, but more importantly, we have an ETF index tracking 30 of the largest global companies, which are listed on the S&P, and they are 30 companies that are involved in the clean energy sector. Now, there is an operating charge, which is a bit high, it's at 0.6%, but given the range of companies and the exposure available, I decided to invest into INRG. Now I did find it quite difficult to find UK-based companies that are sustainable and really push their company towards that direction. These were the companies and ETFs that I decided to invest in. But my question for you this week is, which sustainable companies or ETFs do you plan to invest in? So let me know in the comments below. I'm curious about your thoughts on the companies that I've mentioned as well. And if there are any negatives that I haven't called out, then feel free to leave a comment below as well. So I want to thank those who have reached out to me on my email address. For those unaware, it's jjamesinvestor@gmail.com. You can leave investment related questions and I answer them within the videos. And so the question I received this week is, companies like Tesla, Apple, etc. have all grown so much, whereas dividend-based companies hardly move throughout the year. Why do you focus only on dividend-based stocks? So I'm glad this question was asked, and without a doubt, when you look at my portfolio, the majority are dividend-based. Of course, there's some companies that aren't paying out their dividends, but in the future, we should see a return of those. I'd probably estimate somewhere between 95 to 98% of the companies that I own do pay out dividends. and that's all held within my ISA account. Now I have other trading platforms as well where I'm more aggressive on the growth-based stocks, but within Trading 212 I also have the Invest account. For those that have been with me from the beginning, you'll remember that I first started with the Invest account and then I moved over to the ISA, and I really haven't focused on the Invest account so much. You can see I hardly maintain this, it's a negative 10% as well. But behind the scenes I do actually have some growth-based companies. I don't actually invest a lot into those, but they're on the screen at the moment. You'll see some familiar companies that I started to invest in initially, and then I just focused using the ISA account. So the truth is I do have some growth-based companies. They're not something that I really focus my attention on, and without a doubt I do just showcase the dividend-based companies. And so the separation I have here is for the Trading 212 Invest, I do have growth-based stocks. If I wish to put more into those in the future, then I can do. But for my ISA account, it's mainly dividend-based. And so with the dividend-based companies, I really like the fact that when you receive the dividends, you have the option to reinvest, but in the future, you can take that money and put it towards something else. With growth-based companies, if you hold them long-term, then you're really reliant on the price being higher than when you first bought it. And so for certain growth-based companies, you may want to buy and sell a little bit faster. Given that I don't sell any shares within my ISA account, it's a lot easier just to focus on dividend-based companies, given that they don't actually fluctuate too much and you're still receiving the dividends. And of course we're in an ISA account, so if we do sell out, then we can't add the extra funds. You can see with the utilization I'm at 42% already for this tax year. If I start selling out, then I don't reduce that utilization. I stay at 42%, and so with all those tax benefits I'm just missing out effectively. So that's the separation I have. Of course, it's totally fine to invest in growth-based stocks. I may do that on some occasions with my ISA account if I have no plans on selling them for more than a year. So if anyone else wants to reach out and ask a question, please do so, and you may be featured in a future video. Now I have an article from CNBC. Now we can see that there is some form of a trend towards green investing, so green sustainable investing, and they believe that this type of movement investing is here to stay. And so for sustainable based investment we have equities, government bonds and ETFs. Investors, for the most part, have been demanding more socially and environmentally based options. We've definitely seen that a small number of companies that we can invest in that focus on sustainable based investment. This movement appears to be focusing on a reallocation of capital, which further propels this long-term process. And so we have politicians that normally focus on the growth of a company. It's measured by their GDP, where people are thinking about the environment and how the business operates to be sustainable. Now this has been a constant concern for the majority of governments out there. We have basic necessities such as food, clean water, clean air, but in certain places this isn't the case. And so we look towards companies and try to understand if they are causing long-term problems. Now for sure there's more of an awareness from consumers in terms of how a product is created and how it ends up on the table. And for investors it means that we can look at these green stocks, and so we can argue there's been an increased awareness towards the climate and also how businesses operate, whether they have a high or low carbon footprint. And so as investors we can help support these sustainable based companies. And not only is this a feel-good factor, but it's also asking yourself, are these companies going to be around in the future? I suspect that the companies that will do the best will be those that have the lowest carbon footprint. And so we have investors on one hand that can help propel this movement, but we also have governments that are increase in investments. When the government supports green industries, it gives the investors confidence, and that's the trend we're seeing here in terms of the equity market. And so we have an opinion here that green stocks could over time become some of the world's most valuable companies, even reaching higher values to the current technology monopolies. And of course we have regulation that is always being introduced to some of these larger based companies, and we have a recommendation here for investors to shift in their portfolios towards green green-based stocks so that they don't miss out on this long-term opportunity. Now, there are some robo-advisors out there that will tailor a portfolio to be more sustainable, but you generally have to pay a premium. That's why on the Trading 212 platform, I like to buy my stocks individually. If I want a broad spectrum, then I just buy an ETF. But there was a study published where investors are willing to pay 70 cents more for a share in a company that gives $1 or more to charity. And it was also revealed that firms that have a negative social impact were trading at 90 cents less per share than those that were considered socially neutral. And so this shows the demand by investors that are willing to forego extra money given that they see the long-term potential of these sustainable companies. The concern I do have is for certain platforms to focus the socially responsible aspect and then charge a premium. So try not to be caught out by that. We can see the increase in prices with ETFs as well. There's just this constant trend with prices increasing to all-time highs. So what do you think? Are these green stocks here to stay? Are you willing to focus your money on more sustainable based companies? Let me know in the comments below. So I hope you enjoyed this video. Feel free to give a thumbs up. For those not subscribed yet, do consider subscribing. And with that said, I'll catch you in the next one.